Over $20 billion in physical gold was pulled out of COMEX vaults last quarter alone. While the headlines told you the rally was over, this is Kenji Sinclair. The financial media keeps telling you gold is done because yields are up and the dollar is strong. What they are not telling you is that the biggest buyers in the world, sovereign nations, just had their best quarter of accumulation on record, and they understated the size of it by a wide margin. Today I'm going to show you 3 structural realities the mainstream financial press isn't connecting for you. First, why central banks are quietly building a gold-based settlement system to replace the dollar as global collateral. Second, how China and Hong Kong are physically pulling metal out of the West and into vaults you'll never see audited. And third, why the safe government bond sitting in your portfolio is structured to lose you money, even while it pays you interest. By the end of this video, you'll understand why the people who move markets for a living aren't looking at the ticker. They're looking at the vault door, and I'll show you exactly why that gap between what the headlines say and what the vault data shows should change how you think about your own portfolio. Let's get into it. Here's the part almost nobody in mainstream finance wants to say out loud. This isn't a gold bug story anymore. It's a collateral story. Since the dollar was weaponized through sanctions in 2022, central bank gold buying has run at roughly 5 times its prior pace. Not 5% more, 5 times. 10 of the last 11 quarters have each seen over 200 tons of official gold purchases. That's not a hedge fund chasing a trade. That's sovereign nations rebuilding the foundation of the system itself. Here's the part most people miss. Several of these central banks reported buying that came in far below the actual tonnage moving through settlement channels. Watch what they do, not what they say. And what they're doing is stacking the one asset that isn't also somebody else's liability. If a country holds a U.S. Treasury bond, it's holding a promise. If it holds a 400-ounce gold bar in its own vault, it's holding an asset with no counterparty at all. That distinction is exactly why the official sector has stayed a persistent net buyer, even as retail traders panic sold every 5% pullback this year. This isn't speculation about where gold might go. It's a documented multi-year pattern of the largest, best-informed buyers on Earth choosing physical metal over paper promises, and that pattern accelerates every time Western exchanges raise margin requirements and shake out leveraged retail positions, because every sell-off you panic out of is a purchase the central banks are happy to make at a discount. If central bank buying is the why, China and Hong Kong are building the how. For decades, the price of gold and silver has been set almost entirely by paper futures contracts traded in London and New York, contracts where the vast majority of buyers never take physical delivery. It's a market of claims on metal, not metal itself. That's changing fast. Hong Kong's bullion vault capacity has expanded roughly tenfold as institutional capital moves east. China isn't talking about replacing the COMEX and LBMA paper system. It's quietly finishing the plumbing for a settlement network built on physical delivery, not unallocated certificates sitting in someone else's ledger. The delivery data backs this up. $20 billion in gold moved through COMEX vaults in a single quarter. Billions more, every single month since, even as the paper price got hammered lower. Price is being used as a tool of misdirection. The public sees red candles and sells, while the largest buyers on the planet quietly take the other side of every trade. When physical metal leaves Western vaults and flows east, it doesn't come back. Every ounce that settles into a Shanghai or Hong Kong vault is an ounce permanently removed from the paper system that's helped cap prices for decades. That's not a chart pattern. That's a structural, one-way drain on Western supply, and it's not limited to gold. China's silver imports have also been running at record levels, pulled in by the same industrial and solar demand that's tightening above-ground stockpiles worldwide, when the same buyers competing for gold as monetary collateral are also competing for silver as an industrial input. You get 2 metals under structural pressure from 2 different directions at the same time. Now let's talk about the bond sitting in your retirement account, because this is where it gets personal. Wall Street tells you to calculate your real return by taking the bond yield and subtracting official CPI. Do that math with a 4.5% treasury yield and roughly a 4% inflation print, and you get a modest positive real yield of about 0.5%. Sounds fine, sounds safe. Here's the problem, that math uses a government inflation basket that's been reweighted and adjusted so many times, it barely resembles what things actually cost you at the grocery store or the pump. When you measure actual monetary expansion and real-world basket price increases instead of the official substitute, that safe bond isn't earning you 0.5%. It's losing you purchasing power, year after year, while the interest payment tricks you into feeling like you're getting ahead. Put a number on it. On $10,000 parked in safe bonds, a couple of percentage points of real annual erosion is a few $100s in quiet, invisible purchasing power loss. Every single year, compounding, while your statement tells you you're earning interest. This dynamic has a name: financial repression. Governments and central banks intentionally keep interest rates below the real rate of inflation, so that debt gets quietly paid down in devalued currency, at the direct expense of anyone holding that debt as a safe asset. It's not a conspiracy theory. It's a well-documented policy tool used throughout history whenever sovereign debt gets too large to pay back honestly. And that brings us to just how large that debt has actually become. The United States is carrying close to $40 trillion in public debt. Globally, all-in sovereign and private debt is closer to $360 trillion. Numbers that size stop being abstract. They become a mathematical constraint on policy. Just the interest payments alone on that debt now rank among the largest line items in the entire federal budget, ahead of major categories most people assume come first. That's before a single dollar of principal gets touched. Let me put this in terms that actually mean something. Imagine a household that spent years borrowing more than it earns. Instead of cutting spending, it convinces the bank to keep lowering the minimum payment over and over, so the debt never actually has to shrink. That works for a while, right up until the local grocery store stops accepting the household's IOUs and starts asking for something with real, tangible value instead. That's the position sovereign governments are in today. And there's really only one mathematically honest way out of a debt pile that size without an outright default: dilution. You don't pay down $40 trillion with harder, scarcer money. You pay it down with more of the same paper, issued faster than the debt compounds. That's not a prediction, it's arithmetic. Which is exactly why the short-term wiggles you see on a daily gold chart are tactical noise sitting on top of a much bigger, slower move. The people managing sovereign balance sheets aren't trading the next 5% swing. They're positioning for what happens when a $40 trillion debt pile meets a currency that has to be diluted to service it. So where does that leave you sitting outside the central bank meeting room? The mistake most retail investors make is treating gold and silver like just another speculative trade, something to time, flip, and forget. That's the wrong frame entirely. The point isn't catching the next breakout on a candlestick chart. The point is holding real collateral that doesn't depend on anyone else's promise to pay you back. This doesn't mean panic buying, and it doesn't mean going all in on a single asset class. I'm not a licensed advisor, and you should treat this as a framework for your own research, not a directive. What it does mean is understanding the difference between paper claims and physical ownership, and weighting your own portfolio with that distinction firmly in mind, especially against a debt and currency backdrop like the one we just walked through. Some analysts covering this space have floated long-term revaluation scenarios stretching into the tens of thousands of dollars per ounce if gold were ever formally repriced against outstanding sovereign debt. I want to be direct with you. That is a speculative, long-horizon scenario, not a forecast, and you should treat any specific price target you hear, from me or anyone else, with real skepticism. The structural trend is documented. The exact number it ends at is not. If any of this is new to you, that's exactly the point of this video. Drop a comment and tell me which of these three realities surprised you the most. That tells me what to dig into next. Here's a simple gut check before we wrap up. Look at your own portfolio and ask how much of it is a paper promise versus something you could actually hold in your hand. Let's bring this all the way back to the beginning. Central banks are stacking physical gold at roughly 5 times their historical pace and reporting less than the full picture. China and Hong Kong are building a physical settlement system designed to route around the paper markets that have capped prices for decades. And the safe bond in your portfolio is losing you real purchasing power every single year it sits there, by design. None of that is a prediction about tomorrow's candle. It's a description of a slow, deliberate, multi-year repositioning by the most sophisticated sophisticated capital on the planet, happening in plain sight, while the headlines argue about a 5% pullback. That's the trade the smartest money in the world is already making, whether the daily headlines mention it or not. I'm Kenji Sinclair. If this broke down something you'd only seen in fragments before, hit subscribe. I cover the structural side of gold, silver, and the global debt trap every week, not just the daily price noise. New data drops every few days, and I'll keep connecting it back to the same three realities we just walked through. One more thing before you go. If this video gave you a clearer picture than the headlines have, tap the like button. It's the single biggest signal that tells this channel to keep making the deep, structural breakdowns, instead of the noise. And if you want to understand exactly how the paper futures market keeps prices capped while physical metal quietly disappears into vaults in the East, that's the next video. I'll break down the mechanics of unallocated certificates and why delivery almost never actually means delivery. I'll see you there.